The most popular form of the statement of cash flows is the indirect method because it's the easiest one to create. So let's take a look at how do we create a statement of cash flows using the indirect method. First of all, we have to understand when we prepare the statement of cash flows, there's three sources of the information. We have to do a comparative balance sheet. And what we mean by a comparative balance sheet is a balance sheet where we have the balances for 2 years. We need to know this information because we need to determine the change in the balance from the beginning of the year to the end of the year. The second item that we need is the current income statement. We need the current income statement because the income statement is the primary source of cash. So we need to determine on the income statement what the net income is, and then we need to adjust the net income value by the non-cash transactions that have affected the income statement. And then finally, we need to find any additional information that might provide information regarding the sources and uses of cash. So here is step 1. We first need to determine the net cash provided by operating activities when we start with net income on an accrual basis, and we need to make adjustments to it to get it to a cash basis. So as the graphic says, this step involves analyzing not only the current year's net income statement, but also the comparative balance sheets and the selected additional data. Step 2, we need to analyze the changes in the non-current assets and liability accounts and record as investing and financing activities, and we also need to disclose the non-cash transactions. So in other words, we need to look at how or what changed the balances in the long-term assets and the long-term liabilities and stockholders' equity. Step 3, we need to compare the net changes in cash on the statement of cash flows with the changes in the cash account reported so that we can show where the changes occurred and how we got to that difference. So as we said before, there are two different methods, the indirect method and the direct method. Since there's 3 sections to the statement of cash flows, the investing activities and financing activities are exactly the same for both methods. The only difference is how the operating activities are calculated. As we mentioned before that there are 2 methods, the indirect method and the direct method, you can see in this graphic that the indirect method is by far the more popular method to create the statement of cash flows. So let's create a statement of cash flows using the indirect method. As we said before, the indirect method starts with the income statement. We start with net income, and in this particular example, it starts with $145,000. We take a look at the revenues and expenses of the company on the income statement to determine which of these items are non-cash transactions. We take a look at depreciation. Depreciation is a non-cash transaction. Yes, we use cash to acquire the asset, but as we're using the asset, we are not using cash to generate depreciation expense. The journal entry for depreciation expense was debit depreciation expense, credit accumulated depreciation. So, when we start with net income, we have to add back depreciation expense because there was no cash used to generate the expense. Then we look at the loss on the disposal of plant assets. When we dispose of plant assets, it is not an operating activity, but rather it is an investing activity. Also, our calculation of the loss itself, is not cash related. Yes, we may have received cash for the sale of the asset, but it did not generate the loss itself. So we would have to take the loss on the disposal of plant assets and add that back in to the net income. Then we would take a look at the current assets and current liabilities. We need to take the differences in the change of balances between the beginning of the year to the end of the year. So for instance, accounts receivable went from $30,000 in 2013 to $20,000 in 2014. It therefore decreased by $10,000. We want to do that for every current asset item on the balance sheet. Now that we are looking at the change in cash of $22,000 increase, we do not include that in the operating activities because that'll actually be at the bottom, and this could be our check figure that cash is going to increase by $22,000 after we take into account operating activities, investing activities, and financing activities. Next, we take a look at the current liabilities, and in the current liabilities we can see that accounts payable increased by $16,000, whereas income taxes payable decreased by $2,000. Then we take into account the additional information that's provided for 2014, such as the depreciation expense and the sale of the equipment, and we take a look at all those items to create the statement of cash flows. So, step number 1, we determine the net cash provided or used by operating activities by converting the net income from an accrual basis to a cash basis. We start with net income, and then we have to add back the non-cash expenses, we have to deduct the gains or add the losses, and finally we have to account for the changes in the non-cash current assets and current liabilities. So first of all, we look at depreciation. Remember we calculated depreciation of $9,000 on the income statement? So what we do is we take net income of $145,000 and we add back the depreciation. Then we account for any losses on the disposal of the plant assets. If we have a loss, we need to add it back to the net income. If we have a gain, we have to deduct it from net income. So in this particular example, we started with the $145,000. We add back the depreciation, and because the loss, we want to add back so that now we have net cash provided by operating activities of $157,000. Next, we look at the changes of the non-current asset accounts. So if we looked at accounts receivable, we see that our beginning balance of $30,000, we had sales of $507,000, we have receipts from our customers of $517,000 to give us a balance of $20,000. So accounts receivable decreased by $10,000. So what we'd have to do, because it's a decrease of $10,000, we have to add the $10,000 to adjust the net income. Now, if the increase was to accounts receivable, we would have to do the opposite and subtract the cash out of net income. So what about inventory? Now, if inventory goes up by $5,000, it's kind of like we've used an additional $5,000 to purchase inventory. So what we would have to do is if inventory goes up, we have to decrease the cash as if we were using cash to buy additional inventory. Then if you look at prepaid expenses, When the prepaid expense increases, the cash paid for the expense is higher than expenses reported on the accrual basis. The company deducts the decrease from the net income to arrive at the net cash provided by operating activities. So in the case of prepaid expenses, we would have to deduct from net income because we had an increase to prepaid expenses. Looking at accounts payable is on the opposite side. So when we look at accounts payable increases, we'd have to add it to net income, or when income tax payable decreases, we'd have to decrease it to net income. So we'd have an example like this. So here's a chart to help you remember what we would do to adjust net income so that we can calculate the net cash provided by operating activities. So you want to take a look at this chart and try to memorize whether you need to add or deduct to get the net cash. Next, after we've figured out the change of cash in operating activities, we need to figure it out for the investing and financing activities. Remember, the investing activities are going to be based upon the changes or transactions that occurred in the long-term assets. The financing activities are coming from the long-term liabilities and the stockholders' equity. So take a look at the cash flows from investing activities and financing activities. Here in these two categories, we are actually showing how cash is received or how cash is used in those categories. For instance, if I purchased a building for $120,000 in cash, I'm going to show that cash went down, so I therefore have to show a decrease in cash. However, if I sold equipment for $4,000, I'm going to show that cash went up by $4,000. When I issue common stock for $20,000, cash goes up by $20,000. When I pay a dividend, I'm paying cash out to satisfy the dividend, so therefore cash goes down. Once you've come up with the totals of net cash provided by operating activities and net cash by investing activities and the net cash used by financing activities, you can add and calculate the net increase in cash. You take the net increase in cash and add it to the beginning cash for the period to get the ending cash. So now you have now completed the creation of the statement of cash flows using the indirect method.